Hey, welcome back. I want to talk about buyer's remorse today because it is running rampant through the short term rental industry. And honestly, it's running rampant through the entire real estate industry right now. But the short term rental industry is being affected by it quite a bit. I mean, last week, I just looked at my calendar. I did 32 coaching calls last week. 9 of them were literally people that have buyer's remorse. And what I mean by that is they are upside down hundreds of thousands of dollars. And that all happens on the entry. That's what I want to make 100% clear as we go through this. The entry point is the most important component of investing into real estate. Because if we do our due diligence and we run proformas, multiple proformas, good, better, best, and we're doing that on the comp sets as well, then we can mitigate our risk from making a bad decision. Unfortunately, most of these people that I'm talking to didn't have education like this. They just jumped in the middle of COVID and they looked at the numbers were crazy. Well, they're not crazy anymore. There are four components that go into underwriting a property financially, in my opinion. There's four really important components that we need to go through and we need to evaluate. And I'm going to walk you through all four of those today. The problem with those that made bad decisions is they're just looking at number one, which is cash flow in most cases. So they're looking at rents, they're running AirDNA comps. They might not even be running AirDNA comps. They're literally, we're probably just putting in an address into the rentalizer side of AirDNA and saying, oh my God, this property did $130,000 last year and it's only 600,000. Let's hit that buy button. Today, that does not work. I'll go back to the very first STR Wealth conference that I had. And, the motto there, the theme of that conference was 30% cash on cash, don't settle for less. Well, there's very few people that are finding those 30% cash on cash deals. I got one back in January, right before this year's STR Wealth conference, but I haven't seen one that I'm interested since, to be honest with you. Really looking in that 20 to 25% range. That still makes short-term rentals the number one asset class to invest into, in my opinion. Risk mitigation is much lower than doing crypto, day trading stocks, whatever. You might make more money over a short period of time in the stock market, but I like the security and the longevity of real estate myself. I also like short-term rentals because of the fact that I can do multiple times cash flow, what I can do in STR versus LTR and MTR. And if you're afraid of saturation, which I am not, MTR is more saturated than STR today because it's such a smaller geographical area that everybody is trying to target in these urban markets, predominantly around hospitals, around universities that are much highly regulated than traditional vacation rental markets. So, just to make sure we're all on the same page, I only invest single family homes STRs only in drive-in vacation rental markets. Multifamily, love turning those into motels, turning those into what I call STR. Not really a huge fan of the term boutique hotels, but it's all because of cash flow. Now, if you think about the principles of, the old school way of investing with LTR, they would bypass number one, which is cash flow, right? So that's the advantage, and that's in long term. They're paying 300 grand for, a crappy 3-2 or 150,000 in a section 8 or an opportunity zone. And if they can break even or make 2 or 3 or 400 bucks, they're cool. But for me, I want to leverage all four of these together. Number one is cash flow. I am not doing deals today for less than 20% cash flow on single family homes. Completely different investment strategy when I go into multifamilies because I'm really looking at cash flow and the exit. So that would be the reposition. But for single family homes is what we're talking about today. Cash flow is still my number one metric that I'm looking at. So that's number one. 20% is the minimum for me. Now, you need to fully understand I am still outperforming the 90th percentile of AirDNA and STR Insights by 52%. So I think technically I'm at like 50.8%, but it's been 52 for quite some time. Let's just call it 50% so we don't over exaggerate here. So at 50%, if that property is doing 100 in that percentile, I'm going to do 150 on average, right? So that's a combination of design, ARV, added renovation value in the design. And Bree and I really like to do no reno demo most of the time. We're not doing massive renovations, even though we're on the cusp of completing our biggest massive renovation that we've ever done with almost a $600,000 budget and turning a 7.6 into a 12.9. Most of our stuff is no demo reno. And that could include some tile in a kitchen, could include new countertops, could include new flooring, obviously decor furnishings, but we try not to get into moving walls and, structural components just because it takes so much time. Because one of the caveats to getting the cash flow is speed. Speed is critical to nailing that cash flow. Too many people take way too long from close to going live. And if that takes you, just think about that. I believe the average host, there's really no data on this, but it's like 2 to 3 months. So let's say that it's like 70 days right in the middle, 2.5 months, right? That is almost a full quarter. That's like 20%. So if you're forecasting $100,000 in revenue, that immediately has just dropped down to 80,000. But your expenses don't really change. You're not going to have cleaning costs. You still have utilities. You still have rent. You still have insurance. You still have landscaping, lawn care, all that type of stuff, pool cleaning, that stuff doesn't stop. So that speed to get launched and live and starting to generate cash flow is critical. You really need to understand that. That's why it takes us an average of 8 days to get our properties live, not 80. 8 days, not 80. Huge deal to getting the positive cash flow quickly because those carry costs just don't stop. Number 2 is appreciation. So a lot of people probably are thinking, well, what about the tax benefits, Bill? Cost segregation study. We'll get there in a minute. But number 2 is appreciation. So I want to go back to LTR. That's really where everything has been banked on, is going to be appreciation. And that is also an important component in the short-term rental investing side as well. So you need to go back and look at 17, 18, 19 numbers, right? Any really rock solid real estate agent that knows their market should be able to pull that information from you. And, the National Realtor Association should have that. So then you bypass 20, 21, 22 and go to 23. So that's going to give you a 4-year run rate that's going to be really indicative. And if you want to get 5, go back and look at 16, 17, 18, 19, and then add 23 onto it. I'm not looking at 22, 21, or 20. That's an aberration. It's probably never going to happen again in our lifetime. I don't want to make financially driven decisions based off of what happened during COVID, and I don't think you do either. So appreciation is number 2. What I'm looking at is a minimum of 3% appreciation. There's kind of this sweet spot that I really like around 5, 6%. And if I'm seeing 5 to 6% annual appreciation, think about that. If I can get 5% appreciation on that $500,000 property we're using as an example, that's $25,000 a year in appreciation. If I hold that property for 5 years, that's $125,000 in appreciation. So that's part of the 550-250 plan, right? That appreciation is huge. So the component to this is I want you to really factor that in. This does not go into page 1 of your proforma, by the way. And if you don't have a proforma, and you don't know how to underwrite properties, click the link down below, and I'm going to give you access to the exact same proforma that I use, and also training and how to utilize that proforma so you can mitigate your investing risk. So I'm running a good, better, best proforma on every single property, and I'm running proformas on my top 5, 6 competitors once I've narrowed everything down. And that includes on the second page of the proforma, and I refer to this as a hypothetical second page, is where I'm putting my debt pay down, where I'm putting my tax benefits, where I'm putting my appreciation. So that appreciation number is not something I'm banking on in the proforma. That's kind of the icing on the cake, right? Because I'm really buying for cash flow, but number 2 is going to be appreciation. So, and I'm buying closer to $1 million properties now. So that could be $50,000 a year. That's $250,000 in 5 years. This is where, if you're not a believer in the 550-250 plan, I'm going to just take a break here for a second and explain to you what I'm going through here are the 4 critical components of executing the 550-250 plan, right? And this means that we need to nail cash flow, at least 15%. And if you're at 15%, you're probably going to be able to push this, if you make the right buy, to 20 or 25%. So if I'm doing 15% in my cash flow, and let's say I'm buying $1 million property, and I'm going to do $150,000 a year in revenue, I want $200,000. Well, if I can get that 5% appreciation, right, over the long haul, now I'm at $200,000. Now imagine I take that $1 million property, and we're moving into number 3 here, the tax benefits, right? Cost segregation percentage is at 60% this year. So if I go and buy $1 million property, And let's just say I'm buying it in the mountains. We'll say lot value's 200,000, dwelling value's 800,000, and I get 25%, of that dwelling accelerated depreciation on $800,000. Let's just say I'm looking at 180 grand. So I fall into the 40% tax bracket, 42%. We'll just take 40% of 180 grand. So 50% is 90. That's like, we'll just call it $75,000, dollar for dollar tax benefit, right? So that means in year number one, I'm going to be able to write off $75,000 of that $150,000 in revenue. Let's just assume that's purely profit. So actually, let's say we do, $75,000 in net income. Boom, there goes my tax bill. So that literally has increased my cash on cash again. It's just delaying that a little bit. So those tax benefits are what's critical. That's one of the reasons that we need to have the properties in their own LLC. So then we can look at, segmenting and segregating our expenses. And you really need to understand how you're going to write off all of those expenses, because if I can literally get that down to like 25 or 30,000, even though the real cash flow is like 75, through my travel, through my food, through, my workday expenses, all that type of stuff, then I can apply that additional cash to my next investment. So that's number 3 is going to be the tax benefits. Number 4 is going to be debt pay down. And this is something that a lot of you miss on the debt pay down. And there's a reason that literally like my first 23 short-term rentals that I purchased were all commercial loans from local commercial banks, and they were done on a 20-year amortization. And the reason that I do 20-year amortizations is because the delta between a 20-year AM and a 30-year AM on $1 million property is going to be about $300 to $400 a month. So does that negatively impact my cash flow? 100% that it does. But since I average about 3.5 years in holding a short-term rental before it appreciates to a point where I do a return on equity audit and I'm probably going to sell and then, level up. I mean, folks, that's how I've gone from $400,000 properties to $1.6, $1.8 million properties. No more cash, just taking advantage of this stuff. The appreciation, a big deal. Rolling in the tax benefits, rolling in my debt pay down. So I'm looking at principal gain, paying my debt down, right, over like the first 3 to 5 years of a typical 20-year amortization versus a 30-year amortization is going to generate about close to 32% more cash for me. So that means I'm paying the debt down 32% faster. Now, this all varies from bank to bank. That's why one of the things when I'm negotiating with a bank and I'm honing in on some different terms, I want to know, I'm going to ask them for the amortization schedule so I can see what percentage is going to principal and what percentage is going to interest over that time period. I'm going to calculate that first 5 years. If I'm doing a cost segregation study, I'm really doing that over 5 years, right? Because that's when the cost segregation, those tax benefits are going to pretty much the majority of the accelerated depreciation is going to be recaptured over that first 5 years. We will have to pay some back through another lazy man's, cost seg, reinvesting into another property, doing another cost seg or a 1031, if those things even still exist at the end of this year. So the tax benefits, we need to kind of amortize that schedule based on which ones we're taking advantage of. But that debt pay down, the last 3 properties that I've purchased, which is the first time that I've done a second home loan through Fannie and Freddie, is on 30-year AMs. Everything else that I have is on a 20-year AM, with the exception of one property. That's my big banner out property. I did a DSCR loan through the lender, right around, I think it was 4%, maybe 4.25%. I did a 40-year AM on a 30-year note, interest only. The only reason that I did that is I wanted the flexibility of the cash flow to have the lowest available payment, right? 1.6 million, I put $400,000 down. I financed 1.2 million at roughly 4%, amming that on an interest only over 40 years, right? My payments, I don't know, it's like $4,000. Property does between 255 to 285 for the last 2.5 years, right? So making plenty of cash flow with a sub $5,000, mortgage payment. The insurance is, $4,000 a year. It's not much, right? So like that total PITI cost is probably running me around, $60K, maybe 58,000, right? So do the math on that. I'm netting well over 100 grand a year, closer to 150 to 160, to be honest with you. So, but I'm escrowing in my own escrow account. If you don't do an interest-only loan, if you are not responsible enough, if you're not dedicated enough, if you're not disciplined enough to create your own escrow account and pay down yourself, you're paying your own principal down into an escrow account. So for me, that goes straight into a checking account that is then swept into a money marketing account, and then I move that into a higher interest-bearing account than that. So that way I'm gaining interest on that equity as well. It's not just sitting in a checking account doing 0.07%. That's why I like the debt pay down of a 20-year AM. And then I go in and I accelerate the payment. So I'm making a minimum of 2 payments a month. Some banks allow me to do weekly, and then I do weekly so that way I can accelerate. Because here's the deal, folks. I want to get to a reposition opportunity as quickly as I can. I'm not looking to buy and just hold, a $600,000 property. I want that sucker to appreciate. I want to do debt pay down as fast as I can. So that way I can reposition that into another property. This is exactly how we execute the 550-250 plan. So those are the 4 things: cash flow, appreciation, got to do your research, go back prior to COVID, tax benefits, accelerated depreciation, and then debt pay down, right? So I would rather give up that $300, $400 a month to accelerate the debt pay down. And then I'm also accelerating my payments, making a minimum of 2 payments per month. But there's one more thing, especially if you are not cash rich, like myself. I wasn't, worth 100 million, hedge fund manager off of, the trade floor in New York City. I was just a regular guy like you when I started. Sure, I have a multi-million-dollar portfolio that's generating over $1 million now. But I didn't start that way. And one of the big things was the minimum level that anybody can execute on creative financing. And I'm not talking about going in and sub 2 and, buying properties for $1 down like Pace gets to. I mean, dude, that guy has access to stuff that even I don't have access to, right? So one of the things that I really want you to understand is, but one thing that I've done from the very beginning, and I learned this in my long-term rental investments and also my commercial deals that I did, is I'm always trying to pull cash out of the deal, always. So I've averaged about $27,000, $28,000 per deal, like 67 deals. So whatever 67 is, let's just pull that down to 60 and round up to 30, right? Just for easy math, because I'm not really that smart. So I'm going to pull up my handy dandy calculator and look at, okay, 30,000 times 60 is $1.8 million. Since 2018, when I started doing this, started in 2015, but really got aggressive is what I mean in 2018, I've been able to pull back as seller credits $1.8 million in cash. That is 10% of my $18 million plus STR portfolio. 10%. Just because of that creative fund, that is $28,000 at a time. We're not talking hundreds of thousands of dollars. And you may not go through as many properties I did. I flipped a bunch of properties in there as well. I'd never done that before, but I found the prime market to be able to do that at the right time. But every time, even I just did Banner Elk, pulled, I think it was small deal, 670,000, pulled 20,000 in cash, out of that deal. So really important deal. Like if you want to execute that 550-250 plan, if you can pull $25,000 out per property in 4 years, if you do one property a year for 4 years, now you've got an extra $100K for down payments, for renovations, for whatever construction that you need, or to just buy that next, $500,000 property on a 15 or 20% down. So that's your bonus, is make sure you're always getting a seller credit. So many times if I look at a property like the Banner Oak property that was 670, I actually went in and offered over asking, but I asked for a bigger seller credit. And then we negotiated down to, 670. I think I offered 680. It was listed at 675, negotiated down to 670, and then got a $20,000 seller credit. Very important to continue to replenish your coffers, your cash coffers, so you can reinvest. Those are the ways of appreciation, debt pay down, cash flow, tax benefits, and then the creative financing of seller credits is how you're going to be able to execute the 550-250 plan. So make sure you get that free masterclass right down below. I'll see you guys on the next episode.
Thank you for listening to STR Unfiltered, where we give you actionable episodes without the bullshit.